Welcome to the deep dive. This is where we sift through mountains of research data sources, trying to find the patterns, the connections that really explain how things work.
And today, wow, we've got quite a task ahead of us.
We really do. We're looking at the nature of concentrated capital and not just individual billionaires, right? We're talking about these huge, sometimes multi-generational systems of wealth.
Exactly. Dynasties, massive financial institutions, the tech giants. How this concentrated capital actually molds and reshapes global power.
We've got a really diverse set of sources to draw on today, everything from, 19th century industrialists all the way up to AI and modern finance.
Yeah, the goal is to move beyond just talking about net worth figures. We want to explore how that wealth becomes real systemic influence.
Where it blurs the line, you could say, between a personal fortune and something much bigger, almost like governance.
Precisely, that kind of systemic power.
Okay, so where do we start unpacking this? I think we have to begin with some historical context, right? Otherwise, the modern numbers don't really land.
Absolutely, you need a baseline. And for that, some of the historical economic data, drawing from people like Piketty in our sources, is pretty staggering. It really sets the stage.
Give us an example. What kind of scale are we talking about historically?
Well, take France, for instance. In the century after the French Revolution, roughly 1810 to 1910, you look at the top decile, the wealthiest 10%.
Okay.
They owned somewhere between, get this, 80 and 90% of all private wealth in the country.
80 to 90%, just the top 10%.
80 to 90. It's almost hard to conceptualize that level of concentration.
And just to clarify for everyone listening, when we say wealth, we mean assets, right?
Correct.
Property, stocks, land, not just yearly income.
Exactly. Total accumulated assets. And the sources point out that even after, decades of change, world wars, progressive taxation aiming to reduce that, today the top 10% in France still holds around 60 to 65%.
Still incredibly high, but it shows that concentration is remarkably sticky, incredibly resilient over time.
It really is.
Yeah.
But the sources also draw an interesting distinction if you look even further back, like before the revolution, under the ancient regime.
How is it different then?
Well, if you look at national income, so the annual earnings, the top 10% back then, might have captured maybe 50 to just over 60% of the income.
Which is still huge.
Oh, absolutely massive. But the point is, the industrial capitalism of the 19th century actually pushed the wealth concentration, the ownership of assets, even higher, to those 80–90% levels we just talked about.
So industrialization, in some ways, amplified the concentration beyond even what the old aristocracy had managed.
It appears so. Left unchecked, it really drove that accumulation of assets.
And this is where it gets a bit unnerving, right? Because the sources draw parallels to today, particularly in the U.S. Are we seeing echoes of this?
That's the concern highlighted in the research. Current trends suggest it's a real possibility we could be heading towards, well, new historical records for concentration. Maybe not of wealth yet, but certainly of income.
What are the projections looking like?
If things continue on the current path in the U.S., the sources project that by 2030, the top 10% might claim around 60% of the national income,
60%.
while the bottom half of the population could be left with barely 15%.
Wow. That level of income inequality starts to sound very much like the pre-revolutionary France numbers you mentioned.
It's a direct parallel in terms of income distribution, signaling potentially profound structural shifts.
So if the concentration gets that extreme, how does this system hold together? It can't just be about power or force, can it?
No, and this is a crucial concept from the sources, the apparatus of justification.
Explain that. What does it mean?
It's the idea that inequalities, especially extreme ones, are only sustainable long-term if they're seen by the wider society as, well, somehow legitimate or justified.
So people need to believe the system is fair or at least necessary.
Essentially, yes. If the prevailing belief is that the wealthy earn their fortunes through, say, harder work, or being smarter, more efficient, maybe taking bigger risks, and crucially, that messing with that system would hurt everyone, then the concentration can persist.
And this apparatus includes
Everything. Legal frameworks that protect property, tax laws, certainly media narratives, philanthropy. The whole set of ideas and institutions that explain and rationalize the existing order.
which leads us perfectly into some of the foundational figures who didn't just build fortunes but were masters at crafting that narrative. People like Rockefeller and Carnegie.
Absolutely. John D. Rockefeller, Sr., he was American capitalism in many ways back then. His confidence was legendary.
And what way?
Building Standard Oil, he had this absolute certainty. When he was consolidating the oil refineries, he offered owners a choice. cash for their business, or stock in his new giant company.
And he knew the stock was the better deal.
Oh, he knew. He wrote later about how many took the cash and, in his words, laughed in their sleeves at him, thinking they'd gotten the better end of the deal before his venture collapsed.
But he was sure they were wrong.
Completely sure. He said he knew, with customary certitude, that those who took the stock would become incredibly wealthy, forming the bedrock of, well, American high society. It was a move that both built his empire and, in his view, proved his superior foresight and efficiency. Part of that justification narrative right there.
And Andrew Carnegie, he took a different approach with philanthropy, but it was just as strategic, wasn't it?
Maybe even more overtly strategic. His library program is a fascinating case study. It wasn't just about giving away buildings.
No. How did it work?
He'd donate the capital for the building itself, often these grand structures, but on one very specific condition.
Which was?
That the local city or town authorities had to formally agree to fund everything else. The books, the staff, and, crucially, to levy taxes on their citizens forever to pay for the ongoing maintenance.
So it wasn't really a free gift. It was more like a permanent financial obligation he was imposing.
You could see it that way. In fact, his own secretary, James Bertram, who ran the program, apparently referred to this scheme quite openly as a bribe to get towns to establish and, more importantly, maintain these libraries.
Wow. So it forced public investment in his legacy?
Precisely. It embedded the cost of his philanthropy into the public tax system indefinitely. It's a brilliant example of shaping that apparatus of justification. The public sees the grand building, the gesture of generosity, but the underlying mechanism locks in public support and validation for the donor's legacy, generation after generation. #2, the machinery of modern financial power.
Okay, so that industrial dynastic model eventually starts to shift, right? Especially as we get into the later 20th century, particularly the 1980s, capital concentration becomes less about controlling, say, oil fields and more about controlling debt and finance.
That's a major pivot point identified in the sources. The rise of the leveraged buyout, the LBO, the KKR takeover of Argero Nabisco is sort of the iconic example.
And how is this different? What was the narrative then?
The sources describe it almost like a battle. You had established, maybe slightly sleepy, corporate America on one side, and this aggressive new breed of Wall Street titan on the other, using debt to take control and break up companies.
And the money involved was different scale.
Completely different scale and speed. The kind of wealth being generated was astronomical compared to earlier eras. We're talking about KKR partners, for instance, reportedly taking home something in the neighborhood of $50 million a year back then.
$50 million a year in the 80s.
Yeah. And the sources point to deals like KKR's breakup of Beatrice Foods, where they supposedly made around $2 billion. This wasn't about slow, patient industrial growth anymore.
It's about financial engineering.
Aggressive financial restructuring, dismantling companies, selling off assets, loading them with debt, extracting value through leverage. That became the perceived fast track to immense wealth.
But what fueled these massive buyouts? Where did all the debt financing come from? This brings us to junk bonds, doesn't it? And Michael Milken.
Right. The junk bond market, largely orchestrated by Drexel, Burnham, Lambert, and Milken, was the engine. High-yield debt, essentially bonds issued by companies considered riskier. But the sources suggest the way it operated had a real fragility to it.
Like a house of cards, almost.
It had elements of that. It was described as almost like a pyramid scheme of rolling over debt. When one of Drexel's big corporate clients, the ones issuing the junk bonds, got into trouble and couldn't pay,
Yeah.
Milken's team would often step in and arrange what they called an exchange offer.
What did that involve?
Basically, they'd take the existing weak bonds, the ones about to default, and swap them for new bonds, often with even more leverage, maybe different terms.
So it pushed the problem down the road.
Exactly.
Yeah.
It masked the underlying credit issues because technically a default was avoided. The bond was just restructured. This kept the official default rates on junk bonds looking artificially low for a long time, maintaining the illusion of stability.
But that system relied on constant demand, right? Someone had to keep buying this stuff.
Absolutely critical. The whole system was incredibly dependent on finding buyers for this paper. Any hiccup, a market downturn, a failure to arrange one of these exchange offers could threaten the whole structure.
And who were the big buyers getting loaded up with this risk?
A lot of it ended up with savings and loans institutions, like Columbia Savings and Loan mentioned in the sources, and insurance companies like Executive Life. They became huge holders of junk bonds, making them incredibly vulnerable if the market turned or the flow of new debt dried up. It was systemic risk, really, built on this mountain of leveraged debt.
That Highwire Act eventually led to changes, didn't it? The next evolution seems to be the rise of modern private equity firms like Blackstone. How do they differ from the earlier, maybe more personality-driven LBO shops?
Blackstone represents that shift towards institutionalization. The sources highlight their focus on discipline. They moved away from that kind of freewheeling, master-the-universe culture you saw in the 80s,
Towards what?
towards a much more formalized, analytical, almost collegial review process for deals. Stephen Schwarzman, Blackstone's co-founder, was apparently convinced this approach would lead to fewer bad investments.
Makes sense.
But there was also a kind of political genius to it internally. By having committees review and approve deals, it diffused responsibility. It insulated individual partners from blame if something went wrong, protecting the firm's overall reputation.
Interesting. And their investment strategy wasn't just about process, was it? They had a specific approach.
Yeah, quite a contrarian one, often. They understood market cycles deeply. Schwartzman, according to the sources, had this conviction about buying cyclical companies, businesses really sensitive to economic ups and downs right at the bottom of the cycle.
Buying when things looked worst.
Exactly, when everyone else is panicking. Then, crucially, using leverage at that point. So when the economy inevitably recovered, the earnings of those companies would rebound sharply.
And the leverage would magnify those gains.
Magnify them hugely. You get the double benefit of rising earnings and rising valuation multiples. The sources say it could make returns shoot off the charts. It was smart timing combined with aggressive financial structuring.
Risk management meets bold timing. And they didn't just stick to traditional company buyouts, did they?
No, they were flexible. They showed how concentrated capital could move into new areas. Blackstone was apparently the first big corporate LBO firm in the U.S. to launch a dedicated major real estate investment fund.
Ah, applying the same financial toolkit to property.
Precisely. They took their expertise in financial engineering and became a dominant force in real estate, a sector that used to be more fragmented, more local. It showed they could apply their model to almost any asset class, tangible or not.
So if we zoom out again, connect this powerful financial machinery globally, we see this blurring of lines between private capital and national systems. The repeal of Glass-Steagall in the U.S. seems relevant here.
Hugely relevant. That law used to separate commercial banking, taking deposits, making loans, from investment banking, underwriting securities, trading. Its repeal allowed the formation of these colossal megabanks.
Like Citigroup.
Exactly. Banks with balance sheets swelling into the trillions of dollars. This scale gave them the capacity to make enormous bets, massive wagers, as the sources put it.
And they weren't just betting their own money, presumably.
Often using the bank's capital, which implicitly includes depositors' money, for highly speculative activities. And because they were so massive, too big to fail, they often operated with, let's say, less regulatory scrutiny than their size might warrant. Political influence plays a role there, too.
And this concentration of financial power within banks is maybe even more pronounced in other parts of the world. The sources mention Asian godfathers.
Yes, this highlights how concentrated control over the banking system itself can be incredibly powerful and potentially damaging. In parts of Southeast Asia, for example, a relatively small number of tycoons controlled banks that handled a huge proportion of the region's total savings.
And the risk.
The sources argue that the greater the control these tycoons had over the banking system, the more severe the collateral damage was to ordinary citizens when financial crises hit. Their personal interests and the national financial stability were deeply intertwined.
Is there an example of how that control could be used, maybe cynically?
Well, the sources mentioned Li Ka-shing, a very prominent Hong Kong tycoon. There were instances where his investment bankers would structure deals, like spinning off parts of his companies, and sell shares to the public at very high prices.
Okay.
These stocks would often perform poorly later, leaving the public investors holding losses, while the tycoon and the banks had already profited. The sources describe it as a kind of cynical exploitation, leveraging public admiration while using complex financial maneuvers that weren't widely understood. It shows that intense control over the financial system creates opportunities for extraction that aren't available otherwise. Hashtag tag 3, tech, data, and the aggregation of 21st century capital.
Okay, let's pivot now to the 21st century. Because the way capital aggregates and concentrates today, it's increasingly about technology, data, algorithms, not just factories or banks.
Absolutely. And the race for dominance in artificial intelligence, particularly between China and the U.S., really highlights how this new form of capital accumulation works and how national context shapes it.
How so? What's different about China's approach, according to the sources?
Well, one point made is that China's earlier tech boom, often called the copycat era, actually forged a generation of incredibly sharp, nimble entrepreneurs.
Because the competition was so fierce.
Exactly. Unlike maybe Silicon Valley, where one big idea could sometimes sustain a company, in China you had this rough and tumble environment. Companies had to execute flawlessly, pivot quickly, be incredibly savvy with business models just to survive. That intense competition bred a certain kind of readiness for the AI era.
And then came the data explosion.
Right. The sources point to the massive consumer revolution, particularly with mobile payments. Platforms like Tencent's WeChat Pay and Alibaba's Alipay just took off. Suddenly, people were paying for practically anything and everything with their phones.
Which creates a data trail for every transaction.
Enormous one. Yeah. Every purchase, every taxi ride, every shared bike. It refashioned daily urban life into what the sources call the world's richest real-world datascape.
Data as the new oil, as they say.
That's the analogy often used. This constant, massive flow of real-world data is the essential fuel needed to train sophisticated AI algorithms. And having access to that unique, rich data pool is what helped turn China into a genuine AI superpower, truly competitive with the U.S.
And the economic potential is staggering.
Huge. AI is seen as the new electricity. The sources mentioned a PwC estimate from 2017 suggesting AI could add something like $15.7 trillion to the global economy. Whoever controls the data and the algorithms controls a massive slice of that future value.
And the financial system that fuels these massive tech ambitions, often involving huge upfront costs and uncertain payoffs, is venture capital, which, as the sources show with WeWork and SoftBank, seems to have an incredible tolerance for risk and for losses.
The WeWork story is quite something in that regard. The company's whole model, its rapid expansion, required just unbelievable amounts of cash, billions upon billions of dollars, as the sources put it.
Why? Because they were losing so much money.
Massive structural losses on their operations. But the fascinating thing was, for a long time, the investors, VCs, and especially SoftBank's Vision Fund, seemed far more interested in growth metrics, like how many locations they opened or what their theoretical valuation was, than in actual profitability.
Betting on the future.
Betting that more funding would always be available down the line, betting that they could keep growing, keep inflating the valuation, and eventually pass the risk on to someone else, maybe the public markets, via an IPO. It's a core dynamic, sometimes a flaw, in VC-fueled hypergrowth.
And Masayoshi-san at SoftBank, he was willing to make these huge bets, these misadventures, partly because SoftBank itself had a safety net, right?
That's a critical piece of context from the sources.
Yeah.
A huge portion of SoftBank's actual corporate value was tied up in its very early, very successful investment in Alibaba.
Ah, the golden goose.
Exactly. As long as Alibaba's stock price held up, it provided a massive cushion. It meant that Sun could politically and financially afford to take these enormous, high-profile risks and absorb big losses on other ventures like WeWork. The success at the center enabled a kind of risk addiction at the periphery.
We saw a similar dynamic, maybe even more extreme, in the crypto world with Sam Bankman-Fried and FTX, didn't we? Operating on instinct and, what was the phrase, dirty math?
Yeah, dirty math. The sources describe SBF as not necessarily looking for the perfect mathematically optimal trade, but trying to find a good enough opportunity fast, speed and scale over precision. That tolerance for, let's say, rough and ready risk-taking was part of the culture.
But the foundation was even shakier there.
Tragically shaky. The ultimate secret, as we now know, wasn't just risky trades, but allegedly the wholesale misuse, the theft of customer deposits, moving them over to his trading firm, Alameda Research, to cover losses. That's not just financial fragility. It's alleged fraud on a massive scale.
Moving from the financial structures to the people driving this, the creation of this 21st century capital seems reliant on these incredibly driven, sometimes quite difficult founders, like Bill Gates in the early days.
Gates's early reputation, as described in the sources, was really something, known for having, quote, a bad personality and a great intellect.
Meaning?
Described as often obnoxious, dismissive towards peers, but technically brilliant. And his work ethic was just legendary, pulling all-nighters constantly, sometimes literally sleeping on the computer tables at Harvard's Aiken Center, found dead asleep by classmates.
Total immersion.
Total immersion. It was an environment where that raw intellectual power and sheer dedication seemed to matter more than maybe traditional corporate skills or social graces.
Steve Jobs, similar intensity, but channeled differently, more towards design.
Very much so. His core philosophy, according to the sources, was making technology intuitively obvious, linking design simplicity directly to ease of use, using metaphors people understood, like the desktop, the mouse. That was his competitive edge.
But that intensity could also lead to conflict, right? The famous story about the first Mac's price.
Oh yeah. Decades later, literally 25 years after the fact, Jobs was apparently still furious about it.
What happened?
Apple's president at the time, John Sculley, insisted on raising the price of the original Macintosh from $1,995 to $2,495. Jobs believed that extra $500 right at the dawn of personal computing was the single main reason Microsoft ended up dominating the market with cheaper PCs.
He saw it as a fundamental betrayal of the vision.
Absolutely. It wasn't just a pricing mistake in his eyes. It was compromising the accessibility, the core principle. It shows the depth of his personal, almost proprietary control over the product vision.
And then you have someone like Elon Musk, whose vision seems almost boundless, always trying to combine huge, disruptive ideas.
Right. The sources mention his original plan for X.com, which is now evolving into X, formerly Twitter, was exactly that. Combine a social network with a complete financial services platform, payments, banking, everything.
A super app.
A super app, yeah. And it reflects his broader pattern, this attraction to incredibly high-stakes, almost existential ventures. The sources mention a new employee describing the atmosphere at SpaceX and Tesla as being in a constant state of Armageddon.
Armageddon.
Meaning constant crisis, immense pressure, the feeling that failure is always imminent. For Musk, it seems that culture of extreme risk, that risk addiction, is seen as necessary to drive the kind of rapid, concentrated innovation he demands. Hashtag IV. The use of wealth as a tool of influence and control.
So we've seen how this capital gets built through industry, finance, tech. But the crucial next step for you, the listener, is understanding how this wealth is then used, how it becomes a tool for influence, for control, politically, socially. Howard Hughes seems like a masterclass in this.
Oh, Hughes was extraordinary. He operated in this gray area using complex, unconventional deals, often wrapped in a flag of patriotism or necessity, but ultimately serving his own financial and political goals.
Like the big Nevada land swap.
Exactly. His main goal, according to the sources, was avoiding California's high income taxes. So he proposed this massive land exchange with the federal government.
And the justification was?
National security, ostensibly. He framed it as needing land near Las Vegas to build a plant for guided missile devices for the armed services.
Sounds plausible, but the actual exchange
was genius from his perspective. He offered the government huge tracts of remote, essentially worthless land he owned elsewhere in Nevada. In return, he received a much smaller parcel of federal land, but this land just happened to border the incredibly valuable Las Vegas Strip.
Ah, so it looked like an even trade on paper, based on acreage or minimum assessed value.
Precisely. It was structured to appear near even. But Hughes knew the land near the Strip would explode in value, while his remote land was basically undevelopable. It was brilliant financial maneuvering disguised as patriotism, allowing him to avoid taxes and gain an immensely valuable asset.
And he didn't just manipulate land deals, he seemed to manipulate the government directly to get casino approvals in Vegas.
This is where you see the raw political power of that concentrated capital. Hughes wanted to buy the Dunes casino, but that required antitrust clearance from the Justice Department.
Which should have been difficult.
Well, the head of the antitrust division actually advised against the deal in writing. But the Attorney General at the time, John Mitchell, apparently just ignored that advice.
What did he do instead?
According to the sources, Mitchell personally called one of Hughes's representatives and essentially gave him verbal approval. Something like, "From our review, we see no problem. Go ahead with the negotiations."
No formal ruling, no paper trail.
Nothing. Just a gentleman's agreement, as the sources call it, between the top law enforcement officer in the country and an emissary for Howard Hughes. That level of informal, direct influence just bypasses the whole regulatory process. It's profound political leverage.
And we see similar political muscle emerging earlier mid-century with the Texas oil money starting to flow into national politics.
Yes, the sources point to the fight over Leland Olds as a key moment. Olds was the chair of the Federal Power Commission, the FPC, and he was trying to regulate natural gas prices.
Which the Texas oil and gas producers did not like.
Definitely not. It directly threatened their profits. So this became one of the first major instances where Texas oil money mobilized on a national scale, specifically to defeat Olds' reappointment.
And they succeeded.
They did. It showed the power of this newly concentrated capital to influence Washington. It made Texan politicians key players and established this idea that money could be used to target and defeat specific political figures.
Mhm.
The sources mentioned the explicit goal later became defeating liberal politicians like Harry Truman, wealth-buying direct political outcomes.
Alongside this direct political maneuvering, there's the soft power side, controlling the public narrative. We have two really interesting, contrasting examples in the sources: the Sackler family and the Rockefellers.
Very different approaches, very different outcomes. The Sacklers, linked to Purdue Pharma and the opioid crisis, initially used a lot of high-profile philanthropy, museums, universities, to build a positive public image,
Yeah.
while keeping their actual business practices very guarded.
Until it all came out.
Right. And when the details emerged, particularly in that Massachusetts legal filing exposing the tawdry reality, the family's reaction, as described in the sources, was apparently one of fury and denial.
They felt victimized.
Yes. The sources describe a shared conviction within the family that they'd done nothing wrong, complaining the media just wanted to paint them as grotesque and evil. They saw themselves caught in a blame frame. Their immediate instinct wasn't accountability, but aggressive narrative management, even considering a speaker's bureau to push the idea that the company was trustworthy.
Now contrast that with the Rockefellers. A much longer game, it seems.
A century-long masterclass in image transformation. John D. Rockefeller Sr., remember, started out as the high priest of capitalism, the embodiment of the ferocious trust king, seen as the supreme negation of all equality.
A truly negative image.
Absolutely. But through decades of sustained, highly visible, large-scale philanthropy, the family image was gradually, deliberately reshaped
Into
one of dedication to public and humanitarian service. The sources explicitly state this was the long-term conscious work of the current generation and their advisors. They strategically engineered public perception.
And it worked.
Remarkably well. To the point that when John D. Sr. died, newspaper obituaries overwhelmingly focused on Rockefeller, the benign philanthropist, the world's greatest philanthropist. The ferocious trust king narrative had been almost entirely supplanted in the public consciousness. That's incredibly successful soft power.
Finally, let's look at how this control manifests right down at the corporate operational level. Jack Welch at GE is often held up as someone who fundamentally changed corporate America.
Welch is a pivotal figure. The sources suggest his drive wasn't just about personal greed, though presumably that was there, but this intense, world-beating ambition to make GE the most profitable, most admired company on Earth.
Through what became known as the Welch Doctrine. What did that involve?
Relentless focus on shareholder value above all else. This meant aggressive downsizing, cutting hundreds of thousands of jobs over his tenure, earning him the nickname Neutron Jack. Constant deal-making, buying and selling businesses. And crucially, the deep financialization of what was once primarily an industrial company.
What was the impact?
It arguably cemented shareholder primacy as the dominant corporate ideology for decades. Maximizing short-term stock price became the ultimate goal, even if it meant hollowing out workforces or neglecting long-term investment. It demonstrated a certain kind of ruthless efficiency in wielding concentrated corporate control purely for financial results.
And that kind of concentrated control, especially when it's dynastic or family-based, can also be incredibly corrosive internally, right? The Gucci family story seems to illustrate that.
Yes, the Gucci saga is presented as a kind of cautionary tale. The sources describe how Maurizio Gucci's efforts were constantly undermined by infighting. People close to him, his father, his uncle, his ex-wife Patrizia, even the eventual outside investors like Investcorp, everyone seemed to be angling for their own power, their own slice of the Gucci spotlight.
Personal ambition over the business.
It seems so. Constant conflict, vendettas, personal gain taking precedence over stable management. It highlights the inherently unstable, often self-destructive nature of trying to maintain absolute dynastic control over a major corporate empire. The personal dynamics become inseparable from the business, often to its detriment. #V, conclusion and final thought.
Okay, so we've covered a lot of ground here. From 19th century oil barons and railroad tycoons through the leverage artists of the 80s to the data lords and AI pioneers of today. What's the connected thread when we synthesize all this?
I think the central theme, the pattern that emerges across all these different eras and sources is pretty clear. Concentrated capital, whether it's built on oil or complex finance or data, it doesn't exist in a vacuum. It always seems to require a parallel structure, that apparatus of justification we talked about.
Right, the narrative, the legitimacy.
Exactly. And strategic influence projection. Whether it's backroom political deals like Hughes pulled off, or sophisticated image management like the Rockefellers perfected, or just sheer philanthropic scale. That shield, that justification, is essential for extreme wealth concentration to be sustainable over the long run.
Without it, it becomes vulnerable.
It seems so. Vulnerable to political challenge, social backlash, regulatory change. The justification narrative is as important as the capital itself.
And looking forward, the sources hint at perhaps the biggest test yet for this entire structure, for that apparatus of justification. And it comes from AI, but in a different way than we discussed earlier.
Yeah, this brings us to a really stark finding from one of the sources, a Bain & Company study looking at the future of work. It considers demographics, automation, inequality.
And the conclusion is?
It's pretty bracing. Their analysis projects that by 2030, globally, employers might need 20 to 25% fewer employees than they would otherwise.
20 to 25% fewer workers needed globally.
That's the projection, which translates, in the U.S. alone, to potentially 30 to 40 million displaced workers, primarily due to automation, AI, and related efficiencies.
That is a staggering number, a potential shock to the whole system. So here's the final thought, perhaps, for you, the listener.
If a core part of the justification for today's wealth concentration rests on ideas of meritocracy, efficiency, rewarding hard work, what happens when the relentless drive for efficiency, powered by AI, developed and controlled by these same pools of concentrated capital? What happens when that efficiency leads to potentially tens of millions of people being deemed economically superfluous?
How does the system justify itself then? If 20% or more of the workforce is displaced not because they aren't willing to work, but because automation has made their labor unnecessary for profit generation?
So the question becomes, given the immense power and concentration of capital we've explored in this deep dive, how will this massive, looming disruption of AI-driven job displacement challenge that fundamental apparatus of justification? When efficiency itself leads to mass displacement, what story, what narrative can possibly sustain the current structure?
A profound question for the coming years. Definitely something to think about. Thanks for diving deep with us today.